institutional investors, they know that wealth transfers during liquidity crises. Okay. And so if you have a liquidity crisis, if you have people panicking, the institutional capital is looking at the data and gets excited, and then they start to come into the picture. They are looking for forced sellers. That creates major discounts. They're looking for these distressed opportunities. They're looking for great assets that can temporarily trade for much, much cheaper than they did for just 5 years ago. Hey everybody, welcome to another episode of Keeping It Real Estate. Everybody says they want to build wealth in real estate, right? Until the market gets uncomfortable. And right now, average investors, they're panicking over interest rates. You got bank instability, you got economic uncertainty, and you've got institutional investors that are quietly preparing to buy. So today, we're going to break down why economic chaos creates massive opportunity in the multifamily real estate market and why the biggest fortunes are usually built during the hardest cycles. So what's actually happening right now? You've got the Fed flooding the economy with cheap money for years, right? We saw that since the great financial crisis. They created an incredible amount of currency, right? You had asset prices, they were inflated everywhere. You have stocks, crypto, real estate, private equity. They all just went berserk, right? Now the Fed is reversing course. Now money becomes more expensive. You got debt that's harder to get. You've got weaker businesses getting exposed. And the simple analogy here, you guys, is when the tide goes out, you get to see who's swimming naked. And the key point is that this is not just a real estate problem, okay? This is a liquidity reset across the economy. And here's why amateur investors generally tend to panic. And most people, they only know bull markets, right? When a market is going up and to the right, everybody looks good. Everyone's making money. Everyone is confident and continues to roll their capital in hopes of continuing to make money. And actually what happens is people become addicted to cheap debt, right? They become addicted to appreciation, the easy financing. And investors confuse volatility with permanent loss. We've got volatility in the market right now, and especially in the multifamily market. If you're selling today, that's permanent loss, okay? Once the deal is sold and you lost your capital, that's permanent loss. It's not coming back. Volatility, on the other end, is a choppy market, but if you're in a position where you have low leverage fixed debt and you're in a submarket where fundamentals are strong, when I say fundamentals, I mean rent, your expenses are under control, your CapEx is under control, and you're in a cash flow state, the volatility does not mean that you've lost your capital. The best thing you can have happen right now in real estate, if you purchased at the peak of the market, is to be sitting in a position of low leverage fixed debt with a great operator that can hunker down and hold and wait for the market to go through this volatile time. The line here is that everybody looks like a genius in a zero interest rate environment. And looking back, clearly that was the case in real estate. And, some of the things that I think need to be thought about as an investor and the lessons to be learned and be learning is that you've got to be cautious when emotions are creating your investment decisions or emotional investing. Generally, emotional investing should be a cue or a sign that you are in a dangerous state. Some of the biggest lessons, again, going back to you guys, are over leveraged operators, right? Just too much debt with variable rate debt, too high of leverage with variable rate debt. It's that simple. It crushed these deals. Another one was just the floating rate debt disaster. I've talked about it a lot. People are familiar with it. You've got this variable rate debt that was floating. The Federal Reserve raised interest rates, and it put these deals into extreme distress. Those are the deals that are worth looking at buying today. They're under extreme distress, and they're being forced to sell. And then another piece is just poor underwriting getting exposed. When things were so good for so long, and I say a 10-year run of multifamily going up and to the right, it became more common and more common to continually to underwrite based off of history. And based off of history, things look pretty dang good. So the underwriting back in 21 and 22 looked pretty dang good, and people bought in. They jumped in. They're like, yeah, it's been that good for the last 10 years. It's going to continue to be that good. Well, musical chair shuts off when the Fed raises rates, things reverse. And now you're underwriting deals very conservatively, very, very different than you underwrote deals back in 21 and 22. And now people are like, yeah, the underwriting looks too aggressive. It's such an interesting scenario and place to be sitting in, looking at the different underwriting from 2021 when investors couldn't get in fast enough, to investors today looking at your underwriting saying it looks too aggressive, when this underwriting looks so conservative here today compared to what it looked like back in 2021. And here's why institutions get super excited during chaos, you guys. Institutional investors, they know that wealth transfers during liquidity crises. Okay. And so if you have a liquidity crisis, if you have people panicking, the institutional capital is looking at the data and gets excited, and then they start to come into the picture. They are looking for forced sellers. That creates major discounts. They're looking for these distressed opportunities. They're looking for great assets that can temporarily trade for much, much cheaper than they did for just 5 years ago. And then you also have sophisticated investors prepared before these downturns hit. And so that's the wealth transfer that is taking place and will continue to take place over these next 2 years. The thing is, and I talk to so many investors today, so many of them that look back at 21 and 22 and have been through pain are making decisions about investing for the next 5 years. So from 2026 through 2031 is when the investment will be. But they're making their decisions to invest based on what happened between 2020 and 2022. So that 2-year window of pain, that was elongated into 23, 24, and early 25 is now so painful and so real and so recent that that's the decision that they're making for 2026 through 2031, a totally different time period, almost a decade apart is where you'll be when you exit. But the decision to invest today is based off of the pain of yesterday. If you're investing, look in the rearview mirror, you're looking the wrong direction, you guys. Another thing that you can do to get ahead of these challenges is having cash reserves. Be patient capital, right? These next 12 to 24 months should be a very great buying opportunity, and think long term. That's one of the pieces with real estate I think that got away from most folks is, hey, I'm going to get in and out in 2 years, maybe 3 max. Realistically, real estate should be 5, 7, 10 years plus. Here's a real example, you guys. You have $100 million deal. Today, it's going to sell for between $60 and $70 million. Not because the property changed, right? Not because the tenants aren't paying rent, but because the debt market's changed. And when capital seizes up, like it has, or people got into these deals with variable rate debt and they're being forced to sell, they are selling at a very inopportune time. And the asset didn't change, you guys. The capital markets changed, right? You've had cap rate expansion because they followed interest rates. You've got this refinancing pressure. You've got debt that's maturing. You've got bridge loans that's in pain. Here's the massive mistake investors make, you guys. Again, you're buying based on emotion, right? You're chasing appreciation instead of fundamentals. I can tell you with certainty, you go back to the deals that were purchased in 21 and 22, they're chasing, it's a complete appreciation game. If you looked at the fundamentals of what was being used for cap rates and rent, no wonder folks got crushed. Or they're ignoring the debt structure. Hey, this is variable rate debt. I've done so well for so long. Let's roll, right? Or lack of liquidity, just not having the reserves needed in order to take care of these large assets. And then lastly, just straight up overestimating rent growth forever. Rent growth has not been even close to what was projected for most of these deals getting done in 21 and 22, not even close. And so the valuations aren't even close. Plus you've had cap rates expanding. Then you got the variable rate debt. It all makes this perfect storm for being a buyer. And what actually matters in multifamily, you guys, when you go back to the fundamentals, it's job growth, population growth, it's durable demand, right? It's cost basis. What are you getting at per door? It's operational execution, great leadership, great management. It's debt strategy. You guys, you got to make your money on your buy, not when everyone feels comfortable. Right now, people are making money on their buy. Here's what smart operators are doing right now. They're raising patient capital from investors. They're building these banking relationships with different lenders. They're negotiating much harder. We've never done a retrade ever in the history of our company until just recently on this deal. We had to go back and retrade them, and it was a successful retrade because the sellers are in a position where they have to sell. Smart capital, smart operators are looking for distressed sellers. They're conservatively underwriting based off market fundamentals. They're staying very liquid. They're playing offense while others freeze. That's the line I'm going to hit back on. They are playing offense while so many others are freezing or are gone. Like, I can't tell you guys how many operators are no longer here. They were here from 2016 through 2021 and they're gone. Now, for those that are still here, not many of them are being offensive. They're on the defense, hunkered down in fear. Here's a difference I want to explain. You're either surviving the cycle versus scaling during the cycle. So here's specifically what I'm looking at. You got Dallas, Fort Worth, you got Nashville, you got multifamily trends, and there are opportunities that may emerge. This episode I want to talk to you guys about right here today is how do you capitalize? How do you move the needle? How do you transition to owning as much real estate over these next 2 years as humanly possible? You got to be buying in super strong markets, right? Where's the job growth, population growth, higher than average cap rates, cash flow, underwriting conservatively, have a team in place, vendors, rinse and repeat value add strategy. Those are things that are going to be absolutely critical. Get your debt fixed. Keep it at a low leverage. And here's what's happened next then. The Fed usually tightens until something breaks. Okay, that's just history. Eventually, unemployment rises. We're starting to see signs of that. I saw the February report. I think it was the February report or maybe March, but 133,000 job losses is what it was revised to. You've got this political pressure building. We're seeing that. We're seeing market stress. Then eventually policy pivots. And I think you all can see as you look at things, this energy shock of higher and higher oil prices, that is going to create ripple effects in the economy. I think it already has, and it's going to take time for it to fully come out. So that's the important point, you guys. And by the time headlines feel positive again, the best deals are usually gone, right? So the biggest opportunities rarely feel safe in the moment. I'm going to say that one more time. The biggest opportunities, they rarely feel safe in the moment. Here's a couple things, you guys. These are quotes and things that I just want you to consider as they ring true for me. Easy money, it hides bad business models. When things were good, when rates were coming down, when cap rates were compressing, you could buy a deal and you pretty much did well purely because money was easy. Number two, another one I think about is discipline matters more than optimism. Disciplined operators right now are becoming unique. The real estate cycles, they don't destroy disciplined operators. They expose the undisciplined ones. So if you have discipline and you know what you're doing, you are rising to the cream of the crop. These next 3 to 5 years could create generational buying opportunities, right? Fear creates discounts and we're seeing it. And liquidity is power during downtimes. If you got value from this episode, make sure you subscribe, share this with another investor, and please leave us a review. And if you're looking to understand where the real opportunities are emerging in multifamily real estate over these next few years, follow along because we're going to keep breaking down what's actually happening behind the headlines. This is Keeping It Real Estate. I'm Dan Breezy. We'll see you next week.